The company we're covering in this special episode feels a lot like Stark Industries in the movie Iron Man. I'm not talking about Tony Stark himself. Think of a company whose brain is much bigger than its muscle. A company with extraordinary technology, relentless execution, and an unstoppable drive to move forward. It delivers breakthrough after breakthrough at an incredible pace. But at the same time, it desperately needs strong system and discipline management to keep everything under control. It's the classic genius engineer archetype. A company with world-class R&D capabilities, exceptional product vision, and an unusual ability to turn cutting-edge technology into highly profitable commercial product. But when it comes to risk management, operational discipline, and building scalable systems, that's not exactly its strongest suit. Just like Tony Stark needed pepper pots, this company also needs someone or something to keep the organization grounded. And today's company is SK Hynix. SK Hynix has finalized the public offering price of its American Depository Receipts, or ADRs, and officially debuted on the Nasdaq Global Select Market. The IPO immediately became the second largest public offering in US market history, behind only SpaceX. Many market observers say SK Hynix has now secured enough global capital to aggressively pursue leadership in the AI memory semiconductor market. Here's the funny part. It's only been a few weeks since the listing, and the stock has already been on a wild ride, up, down, and up again. Even I catch myself wondering, should I buy now or am I too late? A lot of English-speaking financial commentators have been looking at Korea's market volatility this July and saying things like the AI bubble has finally burst, or young Korean retail investors are just over-leveraged, chasing risks because they can't afford expensive apartments. To be fair, there's some truth in there. But here's what's missing. Korea's equity market has long operated in an environment where analysts who issue or sell rating risk being frozen out, sometimes by the very companies they cover, protecting their own stock price. So the market ends up flooded with buy reports, and honest negative opinions are rare. That's not just a research industry quirk. It's a sign of a market where valuation itself has been distorted for years. Foreign banks have more freedom to publish sell reports, sure, but many of their Korean research teams are super tiny, many of times 2 or 3 analysts covering nearly every major industry. So I'm not always convinced they are seeing the full picture, which means a lot of the English language commentary on Korea right now is built on fairly limited view of how this market actually works. My point isn't that fundamentals don't matter, it's that Korea has become an unusual sentiment-driven market. So calling this the AI bubble popping is a stretch. Just let us grow. So if you're asking whether SK Hynix fundamentals are certainly worse, I don't think that's really what's happening. When global markets pull back, Korea tends to overreact. This market is still young, still seeing all the kind of steady, skeptical analysis that mature markets have. So the same drop that ripples gently through the US or Japan hits Korea like a sharp wave. That's not a fundamental story. It's a maturity story. But once I ignored all the headlines and looked only at SK Hynix's fortune chart, I noticed something very different. So before we dive in, let me give you a quick introduction to how to read this chart. Then we will take a look at what SK Hynix chart is really telling us. And before we get started, if you're enjoying this episode, don't forget to hit the like button below. Hi everyone, I'm Minso and welcome to Deep Tech Fortune Teller. Before we dive in, let me give you a very quick introduction to how this whole thing works. The basic idea behind Saju is surprisingly simple. If you're ever taken an MBTI test or looked into Enneagram types, this will feel familiar. It's a personality framework just built on birth data instead of a questionnaire. Whether we're talking about a person or a company, we look at the moment they were born and break it into 4 layers: year, month, day, and hour. Together, those four layers form a birth chart. Now here's a catch. For companies, we almost never know the exact birth time. We usually know the founding date, but not the hour, right? So instead of the reading four layers, we can only read three. You might thinking, wait, doesn't that make the reading incomplete? And honestly, yes, it does. This is why I usually think of the corporate Saju reading as being about 70% complete. The remaining 30% comes from something else. My own experience working in venture capital, years of evaluating startup founders, technologies, and business models. That's where I combine Saju with my own business acumen to reach a final verdict. Each of those layers carries a different mix of 5 fundamental elements. It's quite shy to pronounce it, but I will do it. And wood, fire, earth, metal, and water. And these are the literal elements from nature. And because Saju was originally used by farmers to time their harvest, but these days it is considered as 5 different personality forces. The combination of those forces shape the core character of the person, or in this case, a company. It gives us clues about where a company naturally excels, where it struggles, and what kind of situation brings out its strengths or expose its weakness. Think of it as personality map for a business. One thing I really want to emphasize is this: there is no such thing as a good chart or bad chart. Not for people and not for companies. Every chart comes with strengths and weakness at the same time. Personally, I don't believe success comes from trying to fix every weakness. I'd rather make the strengths so exceptional that they become impossible to ignore, because that's how the real business world works. Screw real students who gets an A in every subject, but business don't. Some of the world's most successful companies would probably fail several subjects, but they are so extraordinary at one thing that it completely changed the game. Alright, let's put this work on SK Hynix. Now, SK Hynix has actually been acquired more than once, which means its founding date has technically changed a few times. Its elite roots were actually a construction company, but in 1986, Hyundai Group acquired it and turned it into Hyundai Electronics. It's a completely different business doing completely different things. So that's the date I'm using for today's reading, because this is really where the company as we know it today was born. Side note, SK Group acquired this company in 2012, which is how Hyundai Electronics, as known as Hynix, became SK Hynix. And that's exactly why you don't tattoo your ex's name on your arm. You never know who's rebranding who. Remember those 5 elements I mentioned earlier? Well, this company's core identity is water, huge amount of it. Water represents adaptability in this chart. This company naturally reshapes itself around wherever the market goes. The right next to the water and sitting in the company's core environment is a massive amount of wood. Here's the thing about the water and wood together. It's simple. Water is what makes wood grow. So this chart describes a company that constantly generating new technology, new product, new ideas from within. It's built for R&D, built for innovation. That's simply how it's wired. On the top of that, some of the strongest position in this chart pointed to something very specific: sharp, precise, technical execution. It means it pointed to patent, proprietary know-how, the kind of deep technical expertise you can fake it out. Here's where it gets interesting. In this chart, the technology this company generates, that wood element, directly fits into something else, fire. And fire in this framework and represents something results, revenue, and money. And here's what that means. This is not a company that depends on someone else's to create value. It takes its own technology, turns around, and sells it directly into the market. I'll say that tech to revenue engine is exceptionally strong here. Okay, remember pepper pots? This is exactly where should become important. There are three things worth flagging here. First, the chart is missing two important pieces. Well, in this chart, one is the element that represents structure, rules, internal system, regulatory relationships, basically the discipline layer of the company. It's just not strongly present here, which means internal systems like HR structure, governance, compliance might not be as tight as you'd expect for a company this size. The other is the element that represents a container, I would say. Think of it as a company's ability to hold on to what it creates. Cash, assets, IP, brand value, such things. This company generates revenue brilliantly, but it doesn't have a strong container to hold that value. So the money keeps getting funneled right back into R&D and expansion instead of building up as reserves. Brilliant engine, weak tank. Sound familiar? Second, the over-expansion problem. The chart shows opportunities arriving faster than the company can comfortably absorb them. Eventually, that starts creating pressure. That wood element here, the one generating all the innovation, has to keep sucking up wave after wave of incoming projects, people, and opportunity, which sounds great on paper. But in practice, that pressure often shows up as burnout or key people quietly working out the door. Third, the partnership patterns. And one more thing worth flagging. This chart shows a recurring pattern in outside partnerships. They usually begin with strong alignment, but somewhere in the middle, there's almost always a renegotiation, a dispute, a shift in terms. Nothing fatal, just a pattern, which means get everything in writing every time. Alright, here's the part you're probably most curious about. If there's a one date of circle on your calendar, it's 2028. That's when everything changes. Here's the big picture first. Broadly speaking, here's the shape of it. The fire phase peaks in 2026 and 27, making this the company's loudest, most spotlight-grabbing years. Then starting in 2028, the chart moves into a phase dominated by metal and earth in this chart. The exact elements this company has been missing. Remember, we talked about the missing container. The missing structure? That's what starts showing up. So the next 5 years tells the story of a company outgrowing its own weakness. Let's go year by year. 2026. The biggest spotlight in company's history. This is shaping up to be one of the loudest, most attention-grabbing years this company has ever had. Expect major deals, explosive revenue growth, big capital inflows, and a serious jump in global brand recognition. But here's the thing, when fire burns this hot, water can dry up fast. In business terms, even with revenue exploding, working capital can get tight. And with this many projects running at once, keep an eye on burnout and keep people working out the door. 2027. Profit becomes sustainable. This is the year the market share built in 2026 turns into something more durable. Real net income. Real recurring contracts. It's also a strong year for locking in official certifications or legal agreements internationally. The risk is here. As more formal structure enters the picture, think revenue sharing terms, equity stakes, expect some friction. Partner dispute, renegotiations again, well, that kind of things. Remember that partnership pattern we flagged earlier? This is where it can resurface. 2028, the most painful, the most important year. This is the big one. Everything before this builds toward it. Everything after this is shaped by it. The entire 10-year cycle shifts here, and it hits directly at the company's existing core business, the very technology and operations this company was built on. In practice, restructuring, divisions splitting off, what else? Overseas entities getting reorganized, and the real chances of aggressive M&A or major governance overhaul. The company's business model itself starts to change, moving away from the selling products and towards something built more on royalties, equity stakes, and consolidated subsidiary earnings. They focus on more than that. There are high possibility to focus more than other things. The risk. This is a genuine identity shift. The company has to let go of the very engine that got it here and rebuild itself around the container it's always left. A strong IP portfolio, holding structure, real assets. That kind of the transformation doesn't happen without some internal pain, which can be leadership changes, growing pains. 2029. Building the wall nobody can climb. By now, the missing pieces we talked about back in the weakness section, structure and container thing, are finally fully present. This is the year this company's technology gets locked in as a global standard, backed by dominant patent and regulatory protection. From an investor's perspective, this stops looking like a volatile growth stock and starts looking like a too big to fail blue chip. This is the kind of investors that hold for stability and long-term value, not just upside. The risk, I guess, is that that same precision and structure cuts both ways. Expect tougher external audit, potential patent disputes, and regulators paying much closer attention. No shortcut allowed here. Legal and compliance need to be airtight more than ever. 2030, peak empire. This is a high point of the entire 5-year arc. Everything this company has built, the technology, the system, the asset, comes together into a massive jump in enterprise value, major strategic tie-up with global giants, and a genuinely dominant position in its ecosystem. We are not just talking number one in Korea anymore. This is the year the company's influence stretches across the entire global industry. I can see a risk here again, and when you get this big, you attract attention. A lot, specifically antitrust attention. Think regulatory scrutiny from the US and Europe, potential lawsuits, national security reviews, and serious tax or ownership investigations. The bigger you get, the more closely the world watches you. Alright, let's bring it all together. So what does all of this actually mean? This back and forth in the stock price? Honestly, not that surprising. Remember what we said earlier. This company has always been the type with a much bigger engine than tank. Brilliant at generating revenue, less effective at holding on to that value. So if things feel shaky right now, it's not because the engine broke down. It's just that the gap this company has always had is finally visible out in the open market. Which brings us to the real question. When should you actually be nervous? Not today, not tomorrow, possibly 2028. That's the year that actually decides whether this company can build real structure or not. Whether it can finally grow beyond the business that runs on half hour alone. Now, as of the July 2026, a lot of the current volatility is coming from outside forces. Supply-demand dynamics, over-leveraged bets, ongoing geopolitical tension, well, that kind of thing. That's real. And it's not about the company itself. But if you are talking about the company on its own merits until 2028, just think of it as an Iron Man who hasn't met Pepper yet. Here's the one takeaway I'd leave you with. Next time SK Hynix is all over the headline and stocks swinging around, just ask yourself one simple question. Is there an engine problem or tank problem? If the engine's still running fine, that's not a red flag. That's just the gap we've been talking about all along. Which deep tech company should I read next? Let me know down in the comment. And it was Minsel, and this is Deep Tech Fortune Teller. See you next episode.